Welcome, ladies and gentlemen, to today's IMFS policy webinar. My name is Volker Wieland. I'm the managing director of the Institute for Monetary and Financial Stability. I'm utterly delighted about all of you being here. I see people are still coming in. That's great. This is also going to be streamed live by various news services as well as on our own website. I will start with introductions in a second. There is still one more speaker who will be brought in by the technical staff in a moment. But it's a great opportunity today. We have actually originally planned the ECB and its watchers conference for March, and then we shifted it, being very optimistic, we shifted it to today, and quickly learned that we had to shift it further to September 30th, when we will talk about strategy and contribute to the listening events of the European Central Bank, the European system of central banks. And today, we're very grateful that nevertheless we can have this webinar. First of all, with Philip Lane, ECB's chief economist. Philip, thank you for joining us today. It's excellent to have you. I will not have long introductions. We know all of you and all your expertise. Philip's, of course, and been listening to what you've been saying and what the ECB has been doing, of course. Philip will have 10 to 15 minutes for his presentation, and he will show slides. He will be followed, Philip will talk about also, of course, the monetary policy response and the outlook. He will be followed by Vítor Gaspar from the IMF, who will still come on as soon as we have the technical link ready. He will talk after him, taking a bit more of the global perspective and also fiscal policy responses. And then we have a panel of 3 experts. You can see here already Elga Bartsch. Elga, thank you for joining us from BlackRock. She will talk a bit more from the market's perspective and react to the presentations, give her own view. Francesco Giavazzi, who is joining us from Italy. Francesco, great to have you. We've already had a few conversations of German and Italian economists in the last few weeks. That was fascinating too. And I will add a little bit of a view on the German economy. Michael Binder will actually, who's sitting there, he will be moderating the panelists. And there will be a time for Philip and for Vítor to respond. And then we will go to questions and answers to the audience. So all of you sitting out there in Europe, in the US, and elsewhere, the Americas, Great Britain, please be aware, you can pose questions. There is the Q&A modus or Q&A mode in Zoom. And so you can enter questions. They will be answered after the panelists, and we'll have actually lots of time for questions. Vítor, great, it's Vítor Gaspar is joining us now also. He will be the second speaker, as I mentioned. So for everyone else, please be aware, you can enter questions in the Q&A modus, and there you can also vote on the questions. So we'll see how the questions most interesting to you, they will pop up or go being lifted up on the list. And Michael Binder will be moderating that part. He will be reading the questions. And please also don't forget, post your questions. If you want to address them to a particular speaker, please write it in the text of your question. So I think everyone's here. Thank you. And I'm handing over right away to Philip. I will basically coordinate the slides. So I will show Philip's slides and you will yell out to me when I should switch. And everyone else, while the speaker is on, please turn off your mic and then you bring back your mics afterwards. So Philip, it's up to you. Welcome. Okay. And I switch to your slides. Just a second. So here they are.
Okay, good afternoon, everyone. My goal today in these opening remarks is to go through, I suppose, 3 elements of how central banks are responding to the crisis and the ECB in particular. So if you think about our job, the job has 3 components. One is the monetary stance, 2 is market stabilization, and 3 is liquidity provision. And essentially, my goal is just to go through those dimensions. But before I go to those dimensions, I think it's natural to start with our kind of macro outlook. So Volker, the next slide. And what this slide shows you is what we published on the 1st of May, which are the different scenarios that we have as of 1st of May. Now, of course, in June, we'll have updated projections with a baseline. And of course, we're working away at taking account of all of the incoming information, both the economic information and the virus-related information in preparing for that. So, but as of 1st of May, I mean, our vision is that the quarter we're in now, quarter 2, is going to be the bottom. What you see is this kind of then partial rebound in quarter 3. And then this issue then from quarter 4 onwards throughout 21 and indeed into 22 is what will that kind of next phase of the recovery look like? Are we going to see a rapid comeback to where the trend line was going to be? Or is there going to be a persistent amount of lost output through some mix of extended interruptions to economic activity because of the restrictions needed to manage the virus, and also the various demand side factors about the behavior of consumption and investment under these conditions of uncertainty. So if you go to the next slide, Volker, it's interesting, first of all, to look at this is now from the European Commission's forecast, is what you see is this really remarkable increase in household savings this year. So you can see the long time series is household savings in the euro area bounces around between 12 and 14, but it's projected to go to 19% of disposable income this year. And then also projected to come back, but not all the way back next year. So this is going to be one of the big macro issues, is how long will households defer consumption? So let me just move on from that to the next slide, which is about investment. And again, what you see here is after the kind of recovery of investment in recent years, what we see is a projection of a significant reduction in the investment rate this year, but again, with a partial recovery next year. And again, this is based on the European Commission data. Now, if those are the private components of expenditure, the next chart shows you what's happening with the government sector. And what you see, of course, as we all know, is there's just some mix of automatic stabilizers and discretionary measures for the euro area collectively. We're going from just a small deficit in 19 to about 8.5 percentage points in 2020. So this is a very big offset, and we do have to think about the macro dynamics in the context of a fairly big fiscal response. Okay, so having shown you the environment we're facing, what is the role of monetary policy? So let me start with the monetary policy stance. And if you like, the cornerstone of financial conditions is the risk-free yield curve. Now, how do we control that? Well, that's our package of measures. We think our negative policy rate on our forward guidance helps to steer the yield curve at short to medium term frequencies, while asset purchases and forward guidance and reinvestment help with the long-term component by extracting duration risk from the financial system. And what you see is essentially what's happened is, well, first of all, for those who like comparing shocks, is the nominal situation right now is quite different to the 07 profile before the last big crisis. So that's very, very consequential for all sorts of calculations. But more simply, compared to the start of the year, if we take mid-January, for example, essentially what we've had is a kind of a slight downward shift at the long end of the risk-free curve. So more or less, the risk-free curve has been maintained or slightly eased compared to the pre-crisis period. But maybe the broader story is this is a situation of, in fact, mostly negative risk-free rates. And of course, that provides a lot of support for the economy and the financial system in different ways. Now, let me skip ahead, actually. Well, first of all, let me go to Volker. I'm going to, well, maybe it's for chart 6, the next chart. It's just, by the way, also in terms of thinking, well, what is the real impact of those rates? It's also useful to think about the real rate, if you just take away expected inflation. And the point here is the real rate in the euro area at the different maturities is significantly negative. So the combination of where the nominal rate is and where expected inflation is projected to be means we have a significantly negative real rate, which is relevant for conditions. And so I think that's relevant in assessing the situation. And then if you go to the next slide, this shows you again the difference now compared to, again, pre-crisis from a kind of mid-January viewpoint. And you can see a very different distribution of the yield curve, of the forward Ionia curve from that. So I should emphasize is that at the long end, you know, we've repeatedly calculated that the asset purchase programs help at the long end by compressing the term premia. And you know, the calculations we have is that the combination of the extra 120 billion from the March 12 decision and then the PEP decision, we think will lower the term premium on 10-year rates by around 10 basis points. So there's significant easing, you know, at the longer end of the risk-free curve from these asset purchases. Now, the risk-free curve is, if you like, the kind of foundation stone. But of course, the overall transmission of monetary policy also depends on the compression of various risk premia. And of course, the counterfactual of no PEP in mid-March or no increase in APP probably would have led to you know, a bigger increase in interest rates in the counterfactual. So to the extent that PEP also and the PEP program also contained some tail risks, then the contribution of PEP to interest rates would be larger than shown in these pictures. Okay, so in addition to trying to protect the monetary stance, clearly in a crisis situation, there's also a role for central banks around the world in terms of market stabilization. So what we had in the first days of March is, as investors absorbed the full implications of the crisis and sought to rebalance portfolios, market liquidity in securities markets dried up, and there was a search for safe havens, given the revision to future forecasts and intrinsically high uncertainty. So the next chart shows you the fact that there's a marked tightening of financial conditions if you look at the left panel. And then the right panel tries to break that down between different components. And what we've seen is there's been some recovery since the mid-March decisions. So we had a very significant tightening in the first half of March, but then our two meetings on March 12 and March 18, and also, of course, in context of other major central banks also doing a lot to stabilize markets, have led to some stabilization compared to the peak tightening. So we can also see these dynamics in other charts. The chart 9 shows you the external financing conditions facing euro area non-financial corporates. And what we see is, again, there's an uptick in the cost of finance through a mix of course, falling equity markets and rising corporate bond yields. And again, there's been a partial reversal of those trends since mid-March. And then you also see that in the stock market prices in chart 10, the next chart, which of course, there's a clear difference between non-financial and financial corporates. And you also see it, for example, in chart 11 in terms of corporate bond spreads having gone up quite a lot, and then the partial recovery since then. And then in chart 12, I think is an important way to think about the sovereign bond market in the euro area. This is the spread of the GDP-weighted average yield against the OIS. And what you see is after a kind of long period of fairly low spread between the average yield and the OIS, there was a pretty big pickup in the first weeks of this crisis. And what we've seen since then is a recovery, further upward movement in yields, and then some compression in the most recent period. We think the role of PEP in market stabilization is visible across all these segments. And of course, when I've talked about in recent blog posts and so on, in addition to the market stabilization that all central banks are doing in the context of a 19 sovereign monetary union, there is a particular role in the sovereign market for market stabilization, given the cross-border dimension of flight to safety dynamics. So at that level, we think the announcement of PEP has halted the tightening in conditions and contributed to a partial reversal. And of course, the flexibility of the PEP also plays a crucial role. By the way, it's not just an issue about pricing. We also have seen a volume effect. So the reopening of the corporate bond market and commercial paper markets in the wake of our decisions has been an important dimension of stabilization. Okay, so then let me come to central bank liquidity and credit provision. So under these uncertain conditions, access to central bank liquidity on generous terms and over long tenors supports the maintenance of credit provision by the banking system. Now, our longer term refinancing operations include both unconditional and targeted programs. If you like, the unconditional programs provide a liquidity backstop to banks and help to support smooth function of money markets, while the fact that we do target the through TLTROs, we can also condition the generosity of liquidity on meeting credit volume targets, which supports credit dynamics. So the maintenance of credit is we think, of course, very important in these conditions, given the shock to firms and to households and the obvious need for extra liquidity when revenues have been interrupted for several weeks or months. Now, what's happening, what we've seen in March is a very big increase in monetary aggregates. So you see here in this picture, there's been this really sharp increase in the growth rates of M1 and M3. And the increase in March was really a record breaker in terms of overall volume. And the same can be seen in M1. Now, in the next chart, we see behind that is this really sharp increase in loans to firms. So there's already in March a pretty big increase in lending to firms, whereas of course for households which have experienced the shock in a different way, it's actually slightly moderated. So the next chart actually tells you that there is an issue, and this is why it's so important to make sure our liquidity policies support credit dynamics. So the next chart shows you the information from the survey and access to finance of enterprises. It's basically kind of the opinions of enterprises about the financial conditions they face. And of course, during the survey, the firms expected the fact that, if you like, the firm level fundamentals and macro fundamentals are looking worse would lead to a tightening of credit provisions, which our liquidity policies can help to offset. And so, you know, I think the same chart can be seen in terms of the bank lending survey, the next chart, where you see what's happening in terms of credit standards. But maybe it's more to emphasize that any tightening of credit standards now is nothing compared to what happened in 2008. So we really have, so far, a lot of containment of any kind of credit tightening dynamics. And of course, one part of this is the fact that through TLTROs, we are providing an incentive to maintain credit. And the next chart shows you that, you know, in the opinion of the banks, the TLTROs are supporting the volume of lending that they are planning. So we do see in these surveys a kind of a behavioral response to the TLTRO program. So let me just conclude. So what I've tried to do there is run through the different dimensions of how monetary policy is working through the stance, you know, through the risk-free curve, through market stabilization, both private sector markets and the sovereign markets, and through liquidity provision. Now, you know, we've been busy with all of those measures, and essentially, as we have repeatedly said in our various policy statements, given the high uncertainty, we have to continuously examine each of these measures to continually assess whether they are properly calibrated and appropriately sized to provide the necessary accommodation needed under these conditions. So as we say in our statements, we are fully prepared to further adjust our instruments if warranted. And this includes increasing the size of the PEP and adjusting its composition by as much as necessary and for as long as needed. So let me stop there.
Okay, sorry, you couldn't hear me. So now you can hear me, yes. Thank you, Philip, for great slides, great talk, very clear and insightful new information for everyone. Instead of taking questions now, we're going to go straight to Vítor from the IMF with a global view. And let's see also a focus on fiscal policy, I believe, which is an important player in this situation. So Vítor, Head of Fiscal Affairs at the IMF, it's great to have you. I'll be showing your slides, so you just tell me when to basically show slides. You have to turn on your mic, Vítor. Can you, Vítor, it's up to you. Can you hear me? No, we can't hear you, so you have to turn your sound on, Vítor. Can you say something? Okay, we're still waiting. Maybe on the Zoom. I mean, I've turned your sound on, so from our side, your sound is on. Okay, unfortunately, okay, that's too bad. Mr. Lehrmann, can you check whether you can turn on Vítor? Can you show your own picture? So
I'll make sure that it's working.
Yeah, can you show your own picture so we see what's happening? Michael, can you turn on your sound also, Michael Binder, just so we can test a little bit here whether everyone can speak. Michael, can you also speak?
Yes, good afternoon.
Okay, good afternoon. So I can hear you. So now we just need to get Vítor from our friend from the East Coast into the conversation.
He seems to have disappeared.
No, I can see his picture. Vítor, can you? Well, we can do the following. Maybe Vítor, maybe you can dial in with the iPhone or something like that, with the same Zoom link, and maybe in the meantime we go to Elga to talk a little bit about markets and then bring you back. And so maybe in the meantime, just check whether you can get in with the iPhone and you can get sound. Mr. Lehrmann, please watch out for that. Yes. So I'm handing over to Elga. I don't need to show slides in this case. So let me stop my screen sharing. So Elga, you want to tell us a little bit about markets, so go ahead.
Yes, thank you very much. So what I wanted to touch on are sort of two aspects of today's discussion. One is the economic outlook and also the policy response, because both of them are obviously key drivers for financial markets over and above some of the temporary dislocations that Philip has already mentioned. But I want to sort of come to 2 points that we think are particularly important for financial markets. And one is regarding the outlook, that it's not so much the near-term gyrations in economic activity, which are very difficult to forecast, but it's really about the medium-term loss in GDP. And we think that at this juncture, a permanent loss cannot be avoided, but we would expect it to be considerably smaller than what we have seen in the wake of the global financial crisis. So if I may, I would like to engage in a little bit of sort of crisis comparison on this, to sort of elaborate on this point. And then on the policy response, my take is that the coronavirus crisis has really spurred a real policy revolution. That's not only in the terms of the speed and the size of the policy response, but also in the extent of the coordination between monetary and fiscal policy. And this coordination, which has happened in an ad hoc basis, obviously blurs the boundaries between the two policy areas, and should require some guardrails to be put around it. Otherwise, this could have some material long-term consequences, and I want to talk about those a little bit as well. So starting with sort of the calibration of the corona crisis shock, and Philip already showed some projections from the ECB, but I think to just take a step back, I think we need to understand sort of what is going on here fundamentally, which is that economic activity is not contracting on its own. It's deliberately brought to a stop by governments for public health reasons. And we have never seen so many large economies shutting down activity on such a scale. And so this is really truly an economic hard stop. But that is an important difference, I think, with the global financial crisis, which wasn't an exogenous shock, that was very much endogenous an overheating financial system that was dealing quite poorly with what effectively was a pretty modest tightening in US monetary policy. So we would really try to look through some of the near-term gyrations in economic activity, because they are almost from an economic point of view meaningless, because they have no information content, because they are driven by the health considerations and the decisions about the lockdown and the reactions of the public in terms of mobility. But we would expect that the activity shortfall initially is at least twice the size of the one in the global financial crisis. And this sort of includes the unprecedented contraction in economic activity by more than 30% in this current quarter in the major economies. But what matters a lot more is the cumulative impact on nominal GDP over time. And that basically is a function of two things: the shock itself, which I already explained is unprecedented, but also the propagation. And both dimensions differ from the global financial crisis, but particularly the second one is the important one, because there isn't that much that we as macroeconomists can do about the first part. So that first part, the initial shock, is much bigger than what we have seen in the global financial crisis. But the difference is really about what follows thereafter, because much of the damage caused by the global financial crisis was really through the propagation that happened through debt deleveraging over many years, which effectively resulted in the weakest recovery in post-war history. And on top of that, we had a permanent downshift in trend growth. And some of the eagle-eyed participants will have seen that some of the scenarios that Philip presented earlier were not seeing a convergence of even the level of GDP in the out years to the pre-crisis trend. We would still expect that at some point you get back to that trend, but we won't be making back all of what we have lost all that we will lose in the current quarter and those that follow in the remainder of this year and the early part of next year. So going back to the global financial crisis, we would estimate the cumulative shortfall in US GDP to have been about 50% of the pre-GFC GDP in the US. And in the Euro area, we're talking well above 100% of GDP due to the subsequent Euro crisis, which sort of, exacerbated the shock and was another sort of separate propagation mechanism. But when we look at current forecasts out there, and even taking the most pessimistic forecasts in the market, the shortfall, permanent or cumulative shortfall for the US is not much more than 20%, and for the Euro area or Europe more broadly, it's around 60% of GDP. So it's clearly much lower than what we saw in the wake of the global financial crisis. And that's, I think, quite important. Of course, this is not guaranteed. It requires a policy response because we need not only sort of to provide a bridge over the cash flow disruptions that we're seeing at the moment, but also make sure that we don't end up with yet another balance sheet recession globally and further financial fragmentations in the Euro area. And the more severe the stoppages are, the longer they last, the higher the risk of some permanent damage to potential economic growth, which could happen through a wave of bankruptcy, which destructs a lot of tangible and intangible capital, as well as a rise in long-term unemployment, which causes damages to human capital responses. So the policy response is really key, and we have seen really bold policy measures being taken to bridge those cash flow disruptions. And I'm sure Vítor is going to talk about some of the measures taken and sort of what we make of it. These policy responses have come together very quickly, but now, of course, the focus is on execution. Does it really happen quickly enough? And is it appropriate relative to the size of what's needed? And potentially, I think we'll find that once we have come to the other side of the economic lockdown, that the economies need additional help to ramp up activity quickly, and their additional programs might be necessary. But let's now look a little bit more closely at what's going on with macro policies, because clearly this is a completely new dimension that we're looking at. I think the first observation I would make is not just about the size and the speed and the global synchronicity of it all, but really that for the first time we see fiscal policy taking the lead. I think that's a marked difference to the global financial crisis, where clearly central banks were very firmly in the driving seat. Now I think it's really fiscal support that is in the driving seat. And that's in part because money needs to be put directly into people's pockets. By people, I mean both households and small and medium-sized companies. But really, it's a fiscal policy effort more than anything. And on the back of this, we have seen quite a lot of sort of spontaneous coordination between fiscal and monetary policy in the US, in the UK, in Australia, and Canada. And that coordination is needed because of that need to go direct, and monetary policy alone cannot do that, provide funding directly to the non-financial private sector. And also it would need to reach a much wider set of entities than a monetary policy usually does. And many central banks, and we heard that from Philip earlier, have committed either to open-ended bond purchase programs, or to have given pretty firm commitments that they would step up their programs if needed, which is I think also novel relative to what we saw for much of the global financial crisis. But so
Elga, can I just?
Yeah.
Just 1 second. I just wanted to alert Vítor, you have sound now. It's working. So whenever everything's good. So sorry for interrupting. I just wanted to say I turned everyone on. So back to you, Elga.
Okay, thank you. Let me just make a couple of brief points on the policy revolution, and then I'll give the floor to Vítor to tell us all how fiscal policy is now in the driving seat or not. Maybe he doesn't share my view. But so let me just stress 3 aspects to this policy revolution, which are really important for financial markets and, for the macro outlook more broadly. The first is this explicit attempt to go direct. So by going direct, I mean bypassing financial sector transmission and directly providing new pipelines to provide liquidity to a much broader set of private sector entities than monetary policy usually would do. The second aspect is that blurring of the boundaries between monetary and fiscal policy. And then the third aspect, which is not so much about monetary and fiscal policy, but is around the various bailout programs that we also see ramping up, which is the conditionality that is attached to companies getting government support. In my view, that policy revolution was inevitable and is going into the direction that we have proposed in a paper that we published last summer with Stan Fischer, Philip Hildebrand, and Jean Bovin, where we talked about the need to go direct in the next downturn. We didn't expect at the time that the need would arise that quickly and that drastically. But what is the concern now is that the coordination is happening. on an ad hoc basis, but it doesn't have proper guardrails and not a clear exit strategy. And that could lead us to very slippery slopes. Central banks are increasingly implementing fiscal policies sort of by credit easing. We see it most clearly due to the institutional setup in the United States, but with monetary authorities sort of venturing into the fiscal space, they're also becoming more vulnerable to political pressures. And as a result, this is a concern. And one way to institute clear guardrails around this coordination would be to define an exit strategy along the lines of what we laid out in the paper published last summer, which is a standing emergency financing facility, where basically the joint policy effort is defined by monetary and fiscal authorities taking joint responsibilities for the inflation outlook and for the financial stability assessment. And the central bank basically defines how much is needed and also determines when this facility is open and when it gets closed again. And fiscal policy can, if they decide to, go well above what the central bank decides, but the central bank clearly defines what part of the going direct effort they are going to fund. And this ex-ante commitment is very important in our view to basically make sure that central bank independence is maintained, because in the current juncture, we might be in the danger of letting the genie out of the bottle. And in that case, it might be difficult to get it back in. If that was to happen, I think we would see more and more political attacks on central bank independence, and those attacks could also be driven by the need for ongoing sort of easy monetary policy in what otherwise could be an uncontrolled rise in long-term interest rates on the back of the sharp increase in public debt trajectories. So that it's nothing short of a revolution what we are seeing at the moment. Maybe if the economy returns quickly to a more normal environment, these policy-related risks could be mitigated. But the longer the current heavy lifting lasts, the more the ad hoc policy coordination will raise some fundamental questions, and especially around who at the end of the day really truly bears the financial risks. So let me stop here. And I hope I have teed up Vítor well on how fiscal policy is now.
Yeah, Elga, thank you very much. First, I like the optimistic note that in overall loss, it'll be much less than the last crisis. But lately, I have started not to hope so much anymore. But on the other hand, also the outlook on fiscal multi-coordination will be still to see. That's why it's great to have Vítor now. You turned on your mic. We should be able to listen to you. Are you there?
Can you hear me?
Excellent. Very good. So I'm going to bring up your slides, and then just go ahead.
Thank you so much. It's absolutely wonderful to have a voice again. And thanks for your patience accommodating my technological challenges. In the meanwhile, I have relatively little to add to what Philip and Elga have already covered, but I really want to repeat a number of things, and I want to very much focus on the extraordinary months of March and April that we have just lived. If you can, please, Volker, move to the slide number 2. The point that I want to make on the left-hand side, which has a logarithm scale, is that COVID is indeed global. It goes much well beyond Europe. And in this chart on the left-hand side, you don't even see Europe. Europe is aggregated into the North Atlantic, where we have a total of almost 3 million confirmed cases. And what you see is that the importance of the epidemic in this geographic area of the North Atlantic dwarfs what has happened initially in East and Southeast Asia, and that aggregate includes China. So clearly in March and April, the epidemic migrated to other geographies. The second point that I want you to please retain from the left-hand side chart is that the rest of the world has quite strong dynamics of the spread of the coronavirus. And the only reason this evolution in the rest of the world is not piquing more attention is because although it is, again, much above what happened in East and Southeast Asia, it's still not as explosive as what we see in the North Atlantic. But at this point in time, as you can see from the different slopes of the curves, the rest of the world is actually experimenting stronger growth rates than what you have in the North Atlantic. And then on the right-hand side, you just have a little bit more of detail, and you see that dynamics in Eastern Europe, the Middle East, and in particular in Latin America are particularly strong. So clearly, the epidemic, the root cause of our current economic and financial predicament is something which is completely a global phenomenon. Volker, could you please move on? So that led us at the fund to model what has been happening in the largest economies as the Great Lockdown. And that led to a sharp revision down in our economic forecasts. As late as January 2020, the IMF was projecting 3.3% in global growth. And in the spring meetings, we came out with -3. We have this sharp fall in 2020 that you can see on the left-hand side. And even in 2021, we will be clearly below our earlier projections with a cumulative loss in global GDP of about $9 trillion. On the right-hand side, you have a flavor of recent conjunctural information. I focus on the United States just for emphasis, but please look at the latest in observation for April and bear in mind that it is the largest jump that we have in the full series that in one case, in the case of industrial production, goes back 100 years. And in the case of the unemployment is from 1948 until now. So clearly the conjunctural developments point to something which is very sharp and very sudden. And in this context, the question is, what is fiscal policy doing? And if you move to the next slide, we will see what we have in our projections. So what we have in our projections is quite a substantial increase in public debt, which is substantially larger than what we had seen at the time of the global financial crisis at its peak in 2009. And that's what you see on the left-hand side. And then on the right-hand side, you see that the accumulation in public debt is very different in accordance with the country group. And we have an increase of 17 percentage points in 2020 projected for advanced economies and 9 percentage points for emerging market economies. In the case of advanced economies, what we have is a one-off jump up and then stabilization. But if you would exclude the United States, one would actually have a projected small decline under our baseline. For emerging market economies, we would have in 2021 a slowdown in the accumulation of the public debt to GDP ratio. But again, if for emerging markets we would exclude China, we would have stabilization. By and large, under our baseline, 2020 would be quite a sharp and significant jump up in the public debt to GDP ratio, and then a stabilization or decline in most countries. But if developments prove less favorable than our baseline, then the increase in the public debt to GDP ratio would be larger and the dynamics less favorable. And Volker, if I could persuade you to move to the next slide, we will now go to a theme that was covered by both Philip and Elga, which is monetary fiscal interactions. What you see on the left-hand side is something which is, I believe, could you go to the previous slide, please, Volker? Familiar to most of you, which is that inflation and inflation expectations have come down quite significantly in most advanced economies. In the case of Japan, we actually have something which is quite remarkable, which is negative medium-term inflation expectations. If we would use alternative measures for inflation expectations in Japan based on consumer surveys, the same type of trends would be apparent. But this low inflation environment, although not as extreme, is shared by a number of emerging market economies. And in the world, inflation trends have been on decline, and many countries have benefited from increased credibility associated with their transition to inflation targeting. Moreover, it's not only in advanced economies that central banks have to care about financial stability. The characteristics of the monetary transmission mechanism and also the preservation of orderly market conditions that applies in emerging markets as well, and operational frameworks for monetary policy implementation are also being adapted in emerging market economies to adapt to the new circumstances. And let's go now, Volker, to our last slide. So what you have on the left-hand side is just the relation between credit ratings and sovereign bond spreads. And basically what you see, I hope, loud and clear, is a pecking order. That is, countries that have better credit ratings also get lower spreads in international sovereign debt markets. Now, what you see on the right-hand side is, I believe, very interesting. So you have a couple of normal months, January and February, where you had like normal issuance. And then you have the last weeks of February and March, where you actually have no issuance at all. I put a vertical line on the right-hand side to indicate the action by the Federal Reserve System in terms of its very ambitious program of asset purchases. And I hope that Philip Lane will forgive me not to have signaled the earlier actions taken by the European Central Bank, but there was a tremendous amount of synchronicity of actions of central banks around the world. So I just used the US Fed as representative. And what you do see in the last week of March and first and foremost in April is quite a substantial amount of issuance. And if you look at the fine print at the bottom of the slide, you have a list of countries that were able to issue during April. And those countries are also identified in the left-hand side chart. So you actually see that it was countries with relatively strong credit ratings that were able to issue. So clearly there was a normalization of market conditions, but quite a substantial amount of differentiation across various emerging market economies. So the actions of central banks, as Philip was arguing, did contribute to a normalization of market conditions, and that has proved compatible with discrimination across different sovereign borrowers. So I hope that this injection of a global perspective may be interesting for our debate today. And if you allow me, Volker, I will stop here.
Well, thank you very much. I'm glad it worked out, both in terms of the connection that we are breaking off at times, but I think it was understandable. Great slides. Thank you also for this picture, for this view on emerging markets. I think, we're so focused on the respective country we're in, so at least, if you look at what the governments are doing, it's so much to look at. We lose touch of what's going on, at least some of us, like me. But I'm handing over to Michael, who will manage the remainder of the panel. I think we have to go pretty short and then address the questions. So Michael.
Thanks very much, Volker. Before I hand over to our second panelist, maybe just a brief reminder that, as Volker Wieland stated introduction, we have the Q&A icon at the bottom of your Zoom window. Some of you already have asked questions. Some of you already have also taken advantage of the opportunity to vote for the questions. Please remember that the questions are ordered according to the number of votes that they receive. So please take advantage of that prior to the beginning of the Q&A session. But of course, for now, we'll continue first with our panel. And it's a pleasure to introduce Francesco Giavazzi, professor at Bocconi University. In recent writings, he has urged for policy action, as otherwise one crisis might morph into many. And I could anticipate that that might be a theme of your presentation now. Francesco, it's all yours.
Okay, good afternoon, and thank you for inviting me. I want to do one thing, which is to push a bit the look forward and ask, how are we going to get out of this crisis, and what will the world and the policy options look like when we're out, and focusing on what would be the main variable, which is the level of debt, both public and private. And Vítor had just shown us in terms of public debt that there would be like 17 percentage point increase on average in advanced economy in the debt to GDP ratio. I would just want to say something very short on public debt, and then a bit more on private debt, because there I think it is less discussed and in some sense, it is more important. And the slides are very simple. On public debt, and I will only use words here. What I want to ask, what are the options when we get to the level of debt we'll have at the end of the crisis? What is likely to happen, in my view, and what instead should happen, in my view? So we will get out with a high level of debt. What are the options? If one looks at history, at episodes of sharp, rapid increases in the debt to GDP ratio, typically after wars, there have been essentially 4 ways to get out of high debt. One was unexpected inflation. If I think of my country, in Italy, in the year after the end of World War II, the price level increased by a factor of 3 in a few months, so that was wiped out. Second, a combination of expected inflation and growth, and this was, again, thinking after World War II, the experience of the 50s and early 60s. Then, in some cases, default or de facto default administrative measures to reduce the value of the debt, which have happened in many cases, more often after World War I, but sometimes after World War II as well. And then the other solution, which is more recent, which is not really a reduction in the stock of public debt, but an absorption of the stock of public debt into the balance sheet of the central bank, which goes along with what we could think of as financial repression. So 4 ways to get around this. What is going to happen, in my view, at least, and let me think about Europe today. I think the Japan model is the most likely one. The ECB is buying and has been buying, even before this crisis, large amounts of public debt. This amount of public debt will stay for a relatively long time in the balance sheet of the ECB. So the debt to GDP ratio in the market will probably not even increase, but may even go down. Of course, the total debt to GDP ratio will go up, but because the interest, as low as it is, paid to the central bank is returned, that is really free in terms of the cost for countries. So that was going to happen. Why it is, in my view, is not a good solution, because, well, we look at Japan and we see this strong 30-year-long correlation between expansion of the central bank balance sheet and low growth. I think it's interesting to ask why this happened. There have been many papers to ask this. I think the main reason why this happened is because high liquidity and low interest rate and uniformly low interest rate, what they do is that they reduce the ability of investors to discriminate among various projects, and which means that not only good projects that could afford higher cost of capital or higher interest rate get financed, but if also lousy project gets financed. And I think part of the story of Japan in this past 30 years is, call it zombie project, zombie bank, but a lot of zombie stuff has been financed because of the very large liquidity and the low interest rate. Now, of course, we understand that from the short-term macro policy point of view, this is what you should do, but longer term, this is why it is dangerous. So I said, what are the options? What is likely to happen? And instead, what should happen? Well, I have a different view. I think that if you study the effect of different combinations of fiscal policy, and maybe think of a term that is loved by the ECB, which is growth-friendly fiscal consolidation. Well, what growth-friendly fiscal consolidation means is a combination of reduction in government spending and reduction in taxes that tend to result in increase in output. So this is what should happen. Is it going to happen? As I said, I think the Japan model is going to be more likely, which means growth is not going to be very high after this crisis. Let me now move to, here we are, to the private debt issue, and I will do this using two papers that were recently presented in this wonderful seminar that every week Marcus Brunnermeier ran from Princeton. One was a paper by Jose Barrero, Nick Bloom, and Steve Davis earlier this week. And I think the message from this paper is strong and simple. We're going to have a lot of reallocation. So we will get out from this crisis. And when we get out of this, it will not be just smooth recovery as we've seen in the aggregated graphs we've seen a few minutes ago, but there'll be a lot of reallocation. The number that Barrero, Bloom, and Davis estimate is about 42% of recent layoffs, and they're looking at US, will result in permanent job losses. Permanent job losses means that doesn't mean these guys don't get back to a job, but will get back to a different job. Now, this is very important because this says that if this is what's going to happen, the winners in the way out of the crisis will be the countries that allow or even help reallocation to happen. So if you have policies that defend jobs as opposed to workers, and that defending jobs, I mean defending companies, independently of whether they are companies that can survive or cannot survive, then these countries will be in trouble. If instead you defend workers, so even if they get a job, you defend them in terms of giving them a benefit and helping them to move to the job that open up, these are the countries that will win. I think this is, we knew some of this was happening, but to see it very so clearly in a paper applied to the COVID crisis, I think was illuminating. So that's paper number one. Paper number two is the second one that is not yet on the list of seminars of Marcus Brunnermeier, but I guess will soon be by Olivier Blanchard, Thomas Philippon, and Jean Pisani. And they look at private debt. They look at what is likely to happen to loans, mostly from banks to companies, and how they should be addressed. And they divide the firms in three groups, those that are privately viable and solvent. So those that are in the good group, those that are in the sectors that will make it out of the crisis by increasing output, increasing employment, and will be able to service the debt they have accumulated during the month of crisis. These are doing fine. Maybe they need liquidity, but they don't have a solvency problem. So this, with some liquidity, if needed, these firms will do fine. Then you have the those are bound to lose. These are the firms that are not viable and not solvent. These are the firms in the sectors that have no future. That now we can only think they might have no future, but that we will discover they have no future. And these are the sectors that is very important not to protect, because we'll be protecting zombies, and this will be a drag on the growth of the economy. And here I think the issue that Olivier, Thomas, and Jean argue is that it will all be about insolvency procedure. You have to invest in the speed of insolvency procedures. And finally, and this is the most interesting group, these are the companies, the third group, that will be viable in the post-COVID environment. So they can make that in the sector that will survive, but they have been made insolvent by the by the shock, and thus they need that restructuring. They need that restructuring, knowing that they will survive. So in terms of the business model, they are in the survival group, but they had a shock and they need to be helped to do this. And there, the proposal that in this paper is argued, but is a big discussion, as you know, also at the European level in the design of the of what the European Commission might do with the recovery fund is debt for equity, namely governments turning debt-like claims into equity claims. But I think what is nice to, as a framework, good papers always are nice because they give you a framework to think about. This way to think about firms in these three different groups and understanding the mistakes you should not make. So the first group, don't worry, give them liquidity, they will do fine. Second group is where you could do a big mistake by keeping them alive while they have no future. And third group, maybe think of intervention like that equity swaps to get them over the temporary insolvency problem, which is only due to the shock, but is not due to the business model. And I think it's, we had, and I finish with this, we had spent decades discussing how to reduce large public debts, and we have experience, we know the goods and the bads about this, and I think it's more interesting to think about the private debt, and that's why I think this paper was an interesting reading. Thank you, and sorry if I took a bit long.
Thank you very much, Francesco. We have one more panelist. The panelist who is coming third is none other than our host. If we were together today in person, then I'm sure you would join me in an enthusiastic round of applause for Volker making sure that even though we had to scratch ECB watchers from the calendar today, we still have such a splendid opportunity to reflect on monetary and fiscal policy. Volker, your contribution, please.
Well, thank you very much. I'm sure actually you don't want to hear me. You want to find out about Philip, why he's in front of us and behind him is the Brandenburg Gate, and either the sun is going up or the sun is going down. So I don't want to delay too much. I'm just going to say a few words basically about the spread of coronavirus and the economic consequences and economic policy measures from a German perspective. And I think I just want to react to a few things others have said. So in terms of the spread, I want to quickly talk about things here. So let me see if you can see my screen. Okay, that's should be fine now. What Vítor actually said is this is shifting to Latin America, and indeed you see that here the new cases in the world are still up, but in Europe, here in Germany, in Italy, in France, they're slowing. We're actually in a situation in Germany where registered infections and outcomes are slowing, and actually the active cases are really coming down. Many people are recovering. There are few deaths. Of course, in some other countries, is quite a bit more. We've been also had a lucky streak in this terrible disease in terms of where the infections were in Germany. But the main thing here is that we are really looking at now, okay, the economy can open up, can recover, but are there going to be second breakouts? So the real challenge is going to be how to manage that. We've kind of focused on monetary and fiscal policy so far and on markets, but markets will have to worry about, is this really the end in Europe, maybe soon in the US, or is it going to come back? That's a serious worry, and we really need to develop smart distancing measures, new technologies, apps, but also lots of testing to avoid any negative impact there. 3 remarks on Germany. Early on, Elga and others, Elga especially, mentioned the shutdown comes from the government. Actually, a lot of it comes from individual decisions, individual reactions. You see that here in the service sector, it's only a small part, the orange one here, which has been closed by government decree in Germany. That's in terms of gross value added. It's more in terms of staff, of course, but it means a lot of it comes from our endogenous reactions, our behavioral reactions. and the government communication. We change our behavior, not just because of government degree, but really government communication. You know, there's fear spreading or there's confidence spreading. And that's really maybe the bigger effect. And that's really now whether we can get out of this in terms of the economy, whether we can get the kind of V-shaped recovery, I think, which was behind Elga's numbers, really depends very much on the communication by governments. Another point on which is interesting, comparing to what Vítor showed us. He showed us what's happening in the US. That's really the huge increase in unemployed. In Germany, the blue line here, it's a very small number of increase in unemployed, but there's a huge amount of increase in terms of short-term work. So looking at the responses, this is fiscal policy response is the first line of defense. It's much more central in my view than what monetary policy can do at this point. It can kind of keep banking afloat and keep credit afloat. But what you see here, we've responded with short-time work, so people remain in their companies. They remain there, they are subsidized, they have a somewhat lower income, but they have still high income, 60, 70% of their income before. They can consume, they can save. Companies don't have to reform, they don't have to restart. They can get the workers back very quickly. Now that's great if what this is what Elga said, a pause in the economy, and then we all get back to work and we have the right mix. But if Francesco is right, if Nick Bloom is right, that basically 40%, just the number which Francesco showed, if they have to basically be reallocated, these layoffs in the US to other businesses, if that's what's going to happen in Germany too, because we don't fly anymore, we don't eat in restaurants anymore, and whatever, if this stays, then of course this kind of policy response has to change. We have to find in a second stage people move away for people moving to other jobs. Thirdly, Germany has, of course, a hugely interconnected manufacturing and industrial sector. Many of those shut down voluntarily because of lack of demand or because of fear of illness. They reopened, but how they can reopen depends on how connected they are. You see here the inputs, huge amounts of inputs in the top industries, manufacturing, metal, and elsewhere. And orange here, the imported component. So we're lucky in the sense that Asia has moved up again and they're producing, and so that those supplies are coming in terms of intermediate inputs. So supply chains are working, but then others such as Eastern Europe or US are being disrupted. The forecasts are getting deeper and deeper. So even though things are looking up on the COVID side, the forecasts are going further and further down. Just if you look at these numbers from 0 to -7, we're not sure yet where this ends. There's been massive fiscal support, short-time work expanded, direct income support, transfers, loans to companies, tax measures, equity injections. In total, let me jump to very nice data from the IMF. Very big thanks to Vítor and his team of putting all this together. Here you see the fiscal measures in the G20 in the response to Corona pandemic. The blue is the outright expenditure revenue relevant measures. The orange are the loans, and it's good to have Francesco here. Both Italy and Germany have responded to the same scale, 30-35% of GDP in terms of loans, guarantees. That part is bigger in Italy, and also my reading is the take-up has been stronger in Germany, but at least the volume is there. So in terms of how we get out of this, I think the strategies for easing the lockdown will be key, and doing that in a way so we don't get second waves of disease and of infections. I want to close on some points which have been raised. What about this crazy German court, right? Is it crazy? What are they doing? There's a lot of uproar in European circles, financial market circles. There was this German constitutional court decision, and some people are asking about that already. First of all, they're not crazy. They're also not anti-Europe. So at least from their perspective, they want to set policies on a course, or they want to see mandates followed. They want to see basically the mandated difference between or differences between monetary and fiscal policy observed. In our situation, it's very different from the US. It's not a federal United States of Europe. It's really countries bound by treaties, but the member states, in the view of this court, are still lords and masters of the treaties. And the court said, okay, we don't have a court case about PEP. So they were very clear on this is not about PEP, at least not now. This is about the PSPP program, which is well known and dear to many. And they said, well, basically it's okay in terms of it's not monetary financing because it obeys certain restrictions. But on the other hand, they raised questions about proportionality. Is this really needed, or was this really needed historically back last year? What some of us remember. And what's really behind this is not necessarily, and I think people misinterpret that, it's not necessarily that we will end up with less Europe. It really forces the member states to think about fiscal solutions to the problems we have. So this links to Francesco. What can be the right fiscal solutions for the multi-union as a whole? The court is really throwing in a stop to say, look, the fiscal issues cannot be resolved by the ECB. So that's, I think, how one has to think about that. That's just a quick final remark on that. Maybe there will be more questions. But with those remarks on Germany, let me hand back to Michael and to finally the awaited questions and answers, where a lot of them are going to Philip, I believe. Thank you.
Thank you very much, Volker. I would suggest that before we start formally on the Q&A, following good ECB watchers practice, we give our speakers, that is Philip and Vítor, a chance to respond to what they heard from the panelists. Now, given that Volker ever just raised the issue of the sentence of the German Constitutional Court, maybe I can combine that with that one most heavily voted for a question that we do have in the Q&A session, where we read that our question is asking, I'm sure the ECB will not formally reply to the German Constitutional Court for many reasons, including its special independence and not setting a precedent. How is the ECB planning to help the Bundesbank in its reply to the German Constitutional Court? So, Philip, maybe if you could get started addressing this question as well as the other issues that you have in mind, having heard the panelists.
Okay, so on the German court ruling, of course, the Governing Council put out a press release which took note of the decision. It also basically reiterated our commitment to doing everything necessary within our mandate to deliver our price stability objective. And the press release also just restated that, of course, the European Court of Justice ruled on the PSPP in December 2018 that we're acting within our mandate. So that's all I want to say on that. The comment, you know, a very interesting issue, which I think came up repeatedly in the discussion, and of course it's in many other discussions in the last couple of months, is the fact that in response to this very large shock, we've seen a lot of central bank action, but a lot of fiscal action as well. So, I mean, I think every central banker speech that I've seen reminds the reader that essentially both are responding to the same underlying shock. So there are, you know, lots of very interesting discussions before this crisis about monetary fiscal coordination, but that's not what we have now. It is not a situation where, you know, because it's essentially, we have a situation where the right answer fiscally, I would agree, is to be fiscally ambitious in response to the shock, but also because there's a lot of downside risk to price stability. The right answer for us as a central bank and every other central bank is to protect price stability, basically through the three mechanisms I mentioned, making sure the monetary stance does not, you know, it protects, you know, the conditions needed, making sure there's a market stabilization going on, because of course the counterfactual to market stabilization is market instability, which is not a good climate for price stability. And then third, liquidity policies. Given, again, a lot of market disruption and, you know, as I was trying to emphasize, the importance of avoiding a credit squeeze adding to the shock. You know, we're busy. But so again, let me emphasize this. Empirically, it's true. There's both a big fiscal reaction and a big monetary action, but it does not follow from that we're in some kind of zone of coordination. You know, I know in the US, because of the way it's been set up, there's clearly an interaction because of the joint programs, essentially, where the Treasury is providing equity or indemnities and so on. But in the European context, it's essentially the two dimensions responding to the same common shock.
Thank you, Philip. Vítor, from your side, any reactions to the panelists, please?
Yes, Michael, by the way, great to see you.
Thank you. Great to see you.
And Philip, I have to thank you very much. I noticed now that you came much closer to the camera that you're wearing a very nice tie, and the color of your tie coincides with the color of the fiscal monitor. And so I'm pretty sure that you had that in mind, and that's very much appreciated. 4 comments from my side. The first one has to do with a chart of the week that the IMF is going to put out tomorrow, quantifying the measures that governments have announced around the world in terms of fiscal actions. And they will now come out estimated at about $9 trillion. That's a very large amount, and it's a revision up relative to what Volker was showing before, although Volker chart was in percentage of GDP. That links to something that Elga Bartsch very much emphasized, which is that the economic and financial consequences of the epidemic are to a large extent associated with measures of containment that have been decided for public health reasons. And what fiscal policy has been doing, mostly up to now, is reacting to those social distancing measures and make sure that households and firms made vulnerable by the crisis have access to relevant lifelines. And so the language that we have been using in this session of fiscal support is completely appropriate for these emergency lifelines. And fiscal policy has been mostly reactive, basically making sure that households and firms have access to the relevant support. Now, these support measures are enormous, as the numbers that I've showed in my presentation showed. And as time goes by, it's crucial to do it right. And this do it right applies to monetary fiscal interactions, but very much applies also to the type of support mechanisms that are put in place for firms. And that is what Francesco talked about when he was summarizing the research by Olivier Blanchard and co-authors. So doing it right is absolutely crucial. Something that I very much tried to emphasize in my presentation was indeed the importance of monetary and fiscal interactions. And here as well, it's very important to do it right. Philip referred to the case of the Fed, where the Fed actually welcomed the support of the Treasury to put in place some credit lines that will allow some market segments, some organizations that normally would not be within the reach of the Fed to get the support from the credit of the Fed. And in order to make that possible, a financial support from the Treasury is necessary. So in that particular case, fiscal and monetary are working in tandem to achieve shared goals. And that's, to my mind, an example of best practice. And if you allow me, Michael, I would stop here.
Thank you, Vítor. I'd love to hear more from you, but appreciate that you give the others a chance to say yet more as well. So I would say let us, given that we have about half an hour left, let us move to the other questions that are part of the Q&A window. Many of those questions will be addressed to Philip. I would, however, say if one of the other speakers or panelists has a strong reaction to one of those questions, once Philip has answered, please feel free to join in as well. There are going to be a couple of questions in any case that are addressed to other panelists and or speakers as well. So let me move to the question that we now have at the top. The question states, I'm just reading it, as the ECB apparently doesn't believe in market yields, what's the correct difference between German and Italian yields? Or asking the question differently, which difference is barely in line with a, quote, good transmission of monetary policy, unquote, to Italy? Philip.
Okay, one of the charts I showed in my remarks showed you the GDP weighted average 10-year sovereign bond yield relative to the OIS. And what we saw is essentially most of the time that difference is relatively small. And it climbed quite a bit in the first weeks of this crisis. So we know that the sovereign yields are essentially very important elements in how lending rates are priced in different countries. We all know the connection between sovereign yields and wider financial conditions. So if you just focus on that as a kind of a basic step, is we know in a 19 sovereign monetary union, it's a basic feature that you can have these in a time where there's kind of liquidity pressures and flight to safety, that you can have essentially a cross-border reallocation, which essentially may contribute to tightening of financial conditions in most of the member countries. So essentially, that's one way to think about it. It's that's a statement that's silent on any individual spread pair you want to look at. It's just simply stating that in general, in a multi-sovereign monetary union, a very basic indicator of transmission is that spread. So what we saw is after PEP that has, and that's, if you like, it's an area-wide index, that there was an announced effect, and it's moved in the most recent data, and this, by the way, just stops on Friday. It doesn't include what happened in the last 24 hours. We do think it's very important in terms of determining overall monetary conditions in the euro area. And if you like, having a program where the benchmark is the capital key, and recall that PEP has a benchmark of capital key, it's the PEP in part works through that. Now, on top of that, you also know that in conditions where you can look at lots of different indicators of where flight to safety and liquidity issues are going to be more elevated. So if you even look at that chart, and if you look at many other charts, is before this crisis, there were significant spreads in the euro area. Those spreads move around. So I'm not saying there's any particular date saying, okay, the spreads are correct in this particular date. But the idea that the euro area is or the ECB is somehow operates through the elimination of spreads is not there, cannot be true. But what we do say is that there's a sharp difference between, if you like, non-fundamental sources of spread movements, versus the spread movements which we have seen there, which are more long run and fundamental based in nature. So I think the principles of flexibility are very important in order to counter episodes where flight to safety and self-fulfilling liquidity problems may emerge, and essentially that's what the flexibility is for. I think it's not the case we're trying to replace market pricing, but it is the case we think in order to protect the transmission mechanism, we do have to play a stabilizing role.
Thank you, Philip. Maybe before I give others a chance to weigh in on this issue as well, a related question. Given persistent sovereign bond yield spreads within the euro area, by the way, moving to the heart of the question, why is then the PEPP not being used more aggressively to compress yield spreads, especially for those countries most affected by the crisis?
Well, we think PEP is operating well. I think I've tried to emphasize in the opening remarks. I mean, just think about well, first of all, there's a fairly basic counterfactual question is, in the absence of having stepped in, what the counterfactual path would look like. But even in terms of the observed path, again, the PEP is there to, in terms of overall monetary stance, I think there's to make sure that the risk-free curve is stabilized or pushed down even. And we do that through extraction of duration risk, which pushes down term premia. It's also to make sure that the transmission mechanism, whereby, if you like, the key weighted or GDP weighted sovereign yield is a very important indicator for area-wide financial conditions and monetary transmission, to make sure that that differential against OIS is contained. And then if we see a kind of unwarranted movements, across individual spreads, that we have the flexibility to respond to that. I mean, I think it's very important. Any monetary policy cannot be graded on an hour-by-hour, day-by-day basis, because we also know, and those of you on the call who are market participants, is every day there's a lot. The pricing on a day-by-day basis is also going to reflect very basic issues such as what's happening in terms of bond issuance. The counterpart to the fiscal action is there's a lot of issuance going on. So, I think it'd be a mistake to somehow having a kind of day-by-day kind of metric saying, well, today we think the PEP is going well. Yesterday we weren't so happy. I mean, because quite often the effects are quite non-linear, and we see lots of factors driving spreads, including yesterday's announcement. So, this is not a game we're going to get into. But what we are going to emphasize is we're clear that if we see the monetary transmission being threatened to across the whole euro area, then we do have a stabilizing role to play.
Philip, would one of our other panelists like to join in on issues of the PEP program and the current stance of the ECB at large?
Well, I mean, if nobody does, I would throw in something, particularly in the context of the ruling of this German Constitutional Court. There was the question, why not tilt the PEP program even more to reduce the spreads of countries particularly strongly affected? Essentially, those would be, I would expect those with a very high debt to GDP ratio, because there is more fear, more worries about whether that is sustainable. And then, to me at least, the program would look more like an OMT program. And the OMT program actually did pass both the European and the German Constitutional Court. Now, I'm not going to, I don't take any position now as where does the European Court rule and does the German Court have anything to say. But in any case, there was a ruling on OMT, and that was under certain conditions considered as okay by both of these courts. And one of them was that it has a backup of an ASM program. And so in this regard, I think it's very encouraging that now countries seem to be more willing to actually apply for the ASM credit lines. I think that's an important element, and that would actually, in my view at least, give the ECB more leeway should they want to do that, because then there would be a fiscal backing for this type of policy, just like in the OMT case.
Okay,
Any other reactions?
Let me just think. I mean, that's a very interesting framing, but it's not the framing we have, because my own view, I think the collective view of the Governing Council is, really the PEP is really a response. Again, it has several roles. One is monetary stance, is that essentially we think there's a considerable generalized downside risk to price stability because of the very large economic shock. And that's, if you like, means, a generalized easing of monetary conditions. I mean, that's about the, if you like, the overall size of PEP. So that's one element. Then the second element is really, and this is where it's really maybe the exact opposite to what Volker said. It's non-fundamental drivers of upward pressure on yields. Because in the conditions, the financial dislocation that was there and remains ongoing, at least compared to pre-crisis times, there's a lot of potential for, if you like, self-fulfilling movements in yields. And it's that non-fundamental element is really the focus of PEP, because as Volker says, if it's driven more uniquely by a decline in fundamentals, then that's, if you like, kind of a fundamental-based approach, where again, in the extreme, if a country is facing a market access issue, then the playbook is there with OMT. So it's of course the fundamentals are moving as well. So there's, it's always the issue about the judgment about that. But I mean, it was visible. It was visible, and the fact is correlated not just across sovereign markets, but also the corporate bond market, money markets. And globally, there was a generalized shock to the functioning of financial markets, and that is market stabilization. So, I think that balance will be, of course, a subject of ongoing discussion, but very much I can tell you that was absolutely, and in real time of those days in mid-March, it was absolutely, it was the non-fundamental financial panic, run for cash, run to safety, illiquidity issues. That was the kind of dominant factor. Because we already had spreads beforehand, which could be linked to debt GDP ratios and other factors, and that remains. So, I think going back even to previous concerns about asset purchases, I mean, the overall intention is aggregate monetary conditions. It's not to eliminate fundamental-based differences in spreads. But I'm sure this will be an ongoing conversation.
Thank you. If there's no further immediate reaction on this one, let us move back to the questions that we do have. The next one is for Francesco. In regards to his slides, distinguishing types of firms. And so the specific question here is, how should we distinguish firms that, I'm quoting, should die from the insolvent firms that should be kept alive? Your microphone, please, Francesco.
Apologies. Of course, nobody knows which firm will survive and which firms will die. But I think the way to think about it is that two things can happen. We are very fast going to forget about the virus. If I look around the city of Milan, where everything was open as of this morning, and I walk around, I unfortunately see very little difference compared to the Milan of February. Actually, there are more people on the road because the weather is nicer. So people are going to forget very fast. And two things can happen. Either the virus disappears and we go back to normal, or, and this is my view, the virus is not going to come back, and therefore we have to realize that social distancing will be a feature of our life. And then who will survive and who will not survive on the firms, where those that will have more difficulty are those where applying social distancing is more difficult. And we can take it from there, but I think it's important to have this in mind, that some of them will have a hard time coming back if the virus doesn't completely disappear.
Thank you. Let us move to a question for Elga. Why do you predict a smaller cost in the US than in the European Union?
Yes, thank you for that question. So there are a number of reasons. First of all, it looks as if the initial lockdown measures were less strict on the whole in the US than in Europe. But the main reason really is that the policy response, both on the fiscal side and the monetary policy side, has been much more forceful in the US. And there is also more policy space. There is not the additional issue that we discussed earlier here about the intra-euro area spreads, which can be a reflection of an increased financial fragmentation as things get more difficult and economies are in deep downturns. And so as a result, there are a number of macroeconomic factors that suggest that the US is going to sort of weather this somewhat better. And then, at least as far as the medium term is concerned, the other point could be, an additional point could be the structure of the financial system. So with the United States being much more capital market oriented, the system often clears faster, whereas in Europe, it sometimes takes a lot longer to work through some of these balance sheet issues. And that could mean that you have sort of a prolonged period where growth is staying below the pre-crisis trend, as some of Philip's projections or scenarios from the May publication of the ECB showed.
Thank you. Let me combine the next two questions because both address fiscal policy with a request for Vítor to respond first, but then opening it to all others as well. So Chancellor Merkel and President Macron yesterday agreed to back a 500 billion or 4% of GDP EU fund backed by European Commission issuance to be repaid by the European Union budget. Do you see this as a game changer for Europe's fiscal response to the pandemic? And could you offer your thoughts on Europe's cumulative fiscal response so far relative to their mass modeling of the size of lost income and capital disrepair due to the pandemic? And then I will combine that with another question per se, but I think related if you think about the whole lack of fiscal policy issues. How should we reduce the public debt in the following years? Via austerity? Question mark. Vítor. If you could please unmute your microphone.
I believe it's done. So a complex question. I would consider the agreement between Chancellor Merkel and President Macron as progress. And clearly, as you know, the fund has been arguing for the importance of a central fiscal capacity for the overall performance of the euro area in terms of macroeconomic stability. And clearly, institutional changes that have been agreed and are in the pipeline in the context of this pandemic are progress, but we will have to see the details in order to have a more complete evaluation of the various elements that no doubt will be put in place. In Europe, the response to the crisis up to now has been marked very much by a very strong reaction in terms of making sure that the lifelines to firms and households that I was referring to were indeed in place. In this context, most European countries were the beneficiaries of very strong social safety nets. And what we do see is that it was not only discretionary fiscal policy actions that helped, automatic stabilizers helped a lot, which is very much in line with the role of automatic fiscal stabilizers that we advocate in the fiscal monitor. Clearly, we're going to have, as many emphasized, higher public debt levels when we emerge from this epidemic. The jump up in debt is quite sizable. Under our baseline, the dynamics going forward are not unfavorable, because as soon as 2021, under our baseline, and for most countries, public debt to GDP ratios would be declining already. But as I showed when I cover the case of emerging markets, heterogeneity across countries is quite substantial. And when looking at issues like debt paths, debt sustainability, the interaction between fiscal developments and economic developments, one has to go case by case, country by country, and the situation is very different across. But something which is different in many countries now is that the situation in terms of inflation expectations, central banks' concerns about orderly market conditions, the monetary transmission mechanism, and the preservation of financial stability allow for considerable complementarities between monetary and fiscal policy. And if you use, for example, the indicators that Philip used in his presentation, one can expect that situation to persist for a relatively long period of time. I stop here, Michael.
Thank you, Vítor. Any other reactions on these fiscal policy questions that we just had?
Maybe since it was a part of the question asking about are we going to get out of high debt with austerity, with the implication that would be a disaster, I would make 2 points. One is that the way to think about fiscal policy today, back relative to before World War II, has to take into consideration the fact that the ratio of government debt, government spending to GDP is much higher today than it was in the past. So any estimate of the multiplier changes depending on the level of spending of GDP. We were at spending over GDP around 25%, 30% maximum in the 2030s. We are in some countries above 50% today. And the impact on the economy of cutting 1% of GDP when you're at 25 is very different when you are at 50. And I think that today the evidence suggests that there are two very different types of austerity. You can implement austerity, that is policies to reduce the debt by raising taxes that result, and this will be an example of many countries in the euro crisis of 2010, in sharp contractions of output, and other attempts that are mostly based on reducing spending that instead are not resulting in, at least not as large reductions in output as the other one.
Thank you. We are getting relatively close to 6. If the host is not instructing me otherwise, I would perhaps try to have 4 or 5 more questions. Some of them I think are quite interesting, and I hope that's going to be okay for all of our speakers and panelists, if maybe we go about 5 to at most 10 minutes over time in the end. So if that is okay, let me please shorten the next question that is addressed to Philip Lane on the PEP program. We talked about it a good bit. Let me just take the part here that asks, how large is the flexibility of the PEP around the capital key, which, if I understand well, has to be fulfilled eventually?
So, I mean, we stated at the outset, it's in the legal act, that the flexibility is there. I mean, the capital key is a benchmark or a guideline, but essentially, if you like, we're goal orientated. What we said is we want the kind of monetary conditions to reach all jurisdictions, and if you like, all asset categories, relevant asset categories. So, you know, I think it's probably better to work backwards from, you know, the fact that the goal is to stabilize and improve financial conditions across the euro area in response to this large shock. So, you know, I don't think it's particularly productive to zero in on the kind of operational details. So, you know, we've said we have the flexibility as needed to deviate from capital key, and you know, that's what we're doing, and that's what we're going to do.
Thank you. Next question is open in the sense that please, any one of you would feel free to address it. Do you see a return to the stagflation of the 1970s?
Shall I take a stab at that? I think there is a risk that we see a less favorable combination of growth and inflation over the medium term, because there is potential for a number of very favorable secular factors such as globalization, technology driving down communication costs, facilitating economies of scale and so on, certainly losing momentum and potentially are being pushed back. So that could cause a negative supply shock that drives up production costs, compresses profit margins, and potentially also pushes inflation higher. But I think you need to make a couple of assumptions for that to work out, and you would also need to assume that a number of policy mistakes are contributing to that. In that instance, of course, with stagflation, it gets increasingly difficult for central banks to do much about it. And stagflation is particularly worrisome for financial markets because it could potentially challenge one of the key tenets of portfolio construction, which is that there is a negative correlation between government bonds and risk assets, notably equities. And so, you know, even a mild whiff of stagflation could potentially have material consequences for financial markets, which is why this is a risk that we would monitor closely, even though at this stage, it's in the near term, it doesn't seem to be imminent, given that initially we most likely will be struggling with some disinflationary, if not outright deflationary pressures. But that you basically have a deterioration of the supply side of the economy is something that we need to monitor. As I sort of said in my prepared remarks, that was one of the big problems after the global financial crisis, that we had a downshift in potential output. At that point, it didn't really lead to rising inflationary pressures, but that, of course, could now be different. But you could easily also argue, picking up some of Francesco's arguments about the structural change that might be facilitated by the coronavirus, that basically accelerates things such as trends such as digitalization, automation, robotization, in order to actually be able to adhere with social distancing requirements, and thus offsetting some potential sort of pressures, let's say on trend productivity growth coming from things such as deglobalization. So I think it's definitely something worth to keep an eye on and to debate, but maybe not something that is imminent, given that we have just opened such a material output gap.
You. In the interest of having relatively broad coverage, let me, with all due apologies to those who asked, skip a question or two because they're relatively close to issues that we already covered. And let me move to the following question that is addressed to Philip. Considering that the European response to the coronavirus is taking a long time, and considering too that the ECB is keeping the yields down, would it be better in the immediate term for the countries to get as much money as they need via debt? Or do you consider that would be dangerous?
So I'm not sure about all the various maintained hypotheses embedded in that question, because in fact, as Vítor said, there's very strong automatic stabilizers in Europe. In fact, there's pretty rapid fiscal responses in many countries, pretty rapid supervisory response by the SSM and other supervisors, and I think fairly timely policies by us. Now, if the question means, of course, that the European level policies are taking time to unroll, so whether the announcement yesterday, the various programs which are not yet, activated. I mean, I think also there's been quite a lot of action at the European level, and of course, for a lot of those programs, it's the rollout, of course, is important, but it's more the fact that there's a lot has been announced and agreed. A lot more in terms of the recovery fund is under discussion now. So I'm not so sure that I see this kind of huge delay in the European policy response. But again, I suppose, like everywhere, the idea that given the size of this shock, given the kind of severe interruption to private sector activity, of course, there's a very large role for governments. In a situation where tax revenue is automatically falling, it's an automatic stabilizer where tax revenue automatically falling, of course, the initial fiscal response is going to be funded by debt. But I think I've yet to see too many deviations from the principle of the correct response to this is a sufficient fiscal response. Now, where the line is between sufficient and, if you like, doing more than that, I think it's for those working in fiscal ministries and governments to closely examine. And I think someone mentioned earlier on, there's also an issue. Some of these are demand driven. So the government sets up a scheme, like a guarantee scheme or something like that. And then how much is taken up will also actually depend on the circumstances of individual firms. And of course, some schemes might be criticized for being bureaucratically complex. In other cases, it's also true that maybe some firms are doing better than and don't need, or have enough in reserve, they don't need full access. So again, I think whether it's for monetary policy or fiscal policy, the issue is to make sure that there's no policy response which is amplifying the shock. And I suppose that basic principle is the most important, as opposed to kind of comparing certain ratios across countries or continents, when that is really the key. How you deliver the protection of macroeconomic conditions and financial conditions and monetary conditions will be a little bit institution specific.
Thank you. Maybe one last question that I would read for Philip, and then I would suggest after that, because I think we'll simply not be having the time to get to all the questions, I would hand it back to the speakers and panelists, as well as the host, for a few final words. So the last question that I would take from here is, for Philip, would the ECB consider to introduce market stabilization as an official measure to achieve its mandate of price stability in its strategy review, or even earlier if needed?
So, I think that brings up certain interesting terminological issues, but as a practical central banking issue, it's global. I mean, the Fed has responded, big way, Bank of England, everywhere. It's, there's no way you can achieve price stability in a situation where, in the absence of the central bank stabilizing markets, you get a very destabilizing spiral, which we know historically amplifies recessions, raises the probability of sustained deflation. And so I don't think, you can have that debate. Is it a separate function, or is it simply a very basic precondition for delivering price stability? The strategy review, we said we leave no stone unturned, and we can turn over that stone and take a look at it in the work on the strategy review. But I think, it's just basically, to me, it's a precondition for price stability.
Philip, so I would suggest I hand back over to our host, Volker Wieland, who then has the decision as to how many more additional responses from our panelists and the speakers to invite before closing today's session. Volker.
Well, thank you very much. Thank you for handling the Q&A so well, Michael. Thank you to all of you for participating. I think it's been great. I think we're over time, so I think rather than adding more, I think it's amazing how many friends, while others have been speaking, I looked through the list of participants, how many friends tuned in, people we know very well from many ECB and its Watchers conferences. I really hope we can see you again in person on September 30th, or then on a much wider screen, so there are many more faces. We'll figure it out till then. Philip Lane mentioned it already. This will be part of the strategy review, the open ear and open eye of the ECB. And I think this community will be enthusiastically contributing to that. So thank you all, in particular, Philip, for standing ready to answer all these questions. Vítor, great, we could bring you in, and eventually also the technical aspects worked well. And thank you, Elga, for providing these great views on the markets and beyond. And Francesco, great. I loved it. We have to talk more about how clever austerity or how clever growth policies work to reduce debt. Maybe at some point we also need to have a webinar on court proceedings and court decisions. There was a lot of interest in that. We can do that too. So goodbye, stay healthy, and all the best to everyone.
Thank you very much.
Thanks, Volker.